Welcome to the Deep Dive. We're TalkTickers, and our job is to listen closely to those earnings calls so you don't have to, bringing you what really matters. Today, we're taking a really close look at the Q2 2025 earnings call from BingXLTD. That's the company behind FlashX, a name you probably know if you follow China's instant delivery scene.
Yeah, they're a big player in a market that's just incredibly competitive, incredibly dynamic.
Exactly. And their latest results, well, they present this fascinating, almost counterintuitive picture. Revenue is actually down year over year.
But, and this is the kicker, their profits are way up. Soaring, actually.
Which makes you ask, right, is this just, a weird quarter? Or are they deliberately changing how they play the game in this really tough market?
I think that's the core question. Is this a strategic pivot?
Let's unpack it. We'll look at the numbers, the strategy behind them, and figure out what's really going on here. So let's kick things off with those headline numbers because they really set the stage. FlashX reported total revenue of RMB 1,024.6 million for Q2.
And like you said, that's down 12.9% compared to last year. On the surface, not great news.
Not usually what you want to see.
But here's where it gets interesting. Despite that drop, their net income attributable to ordinary shareholders, it jumped. A huge jump, actually 140% year over year, hitting RMB 53.5 million.
Wow, 140%.
Yeah, and maybe just as important, their gross margin expanded too, up 120 basis points to 12.0%.
Okay, so they're making less money overall, but keeping more of each yuan that comes in.
Precisely. It suggests they're not just chasing volume anymore. It feels like a real shift towards profitability, challenging that old idea that you just need massive scale in this business.
And how did the market take this? I mean, down revenue, up profit?
Well, that's the other really interesting part. The stock price actually closed up 3.8% on the day they announced, even with that revenue decline.
So investors liked what they heard, despite the top-line dip.
It seems like it, which tells you the story isn't just the revenue number itself. It's about how people are reading these results. What's the bigger picture telling us?
Let's get into that.
Okay, so connecting the dots. Management said that 12.9% revenue dip was mainly because of lower order volumes. No huge surprise there, given how fierce the competition is.
Right, everyone's fighting for orders.
Exactly. But that improvement in gross margin, getting up to 12.0%, that directly shows they're getting better at running the business efficiently and managing costs.
Yeah.
That's critical. They're optimizing.
Becoming leaner, basically.
Yeah, leaner and smarter about each delivery.
Right.
And if you dig a bit deeper into the profit numbers, their non-GAAP operating income was RMB 31.9 million.
Non-GAAP meaning adjusted for certain items.
Right. It strips out things like stock-based compensation or maybe one-off gains, trying to give a cleaner view of the core operation. That translated to a 3.1% operating margin on that non-GAAP basis.
Okay, so core operations are profitable.
They are. But it's also important to note that huge 140% jump in net income got a significant boost from something else, RMB 20.5 million in fair value gains on long-term investments.
Ah, so some of their investments went up in value.
Correct. Which definitely helped juice that bottom line number. It wasn't all operational improvement driving that huge percentage increase.
That makes more sense. It sounds like a mix then. Good cost control internally, plus a bit of a helpful win from their investment portfolio.
I think that's a fair way to put it.
But it still begs that question, how do you really boost net income so much when revenue is falling? Especially in a business like instant delivery that feels so volume-driven, can they keep this up?
Well, that's the heart of this potential strategic shift, isn't it? It shows they have tight control over costs, yes, and they got that investment gain. But more fundamentally, it suggests a real discipline. Maximizing the value from each delivery, not just grabbing every order possible.
Focusing on profitable deliveries.
Seems like it.
Right.
And they have the resources to maneuver. Their cash position is healthy cash, and equivalents are sitting at RMB 827.8 million. That's a decent cushion.
Gives them options.
Definitely. And one option they're actively using is a share buyback program. They've got a US $30 million program authorized through April 2026.
And are they actually buying?
They are. So far, they've bought back about 0.8 million ADSs.
ADSs being the American depository shares, how they trade in the U.S.
Exactly. They spent about US $2.6 million buying them back at an average price around US $3.10 per ADS.
Which is a pretty strong signal from management, right? Buying your own stock back usually means you think it's cheap.
Absolutely. It shows confidence, and it puts a bit of a floor under the stock price, provides some support.
Okay, so the financials tell the story of making more profit on less revenue, which, as we said, points to big strategic changes. Let's dive into how they're actually doing this. How are they navigating that intense competition?
Well, management didn't shy away from acknowledging the competition. They know it's fierce. But they also said the impact on their revenue and profit was, quote, limited.
Implying their strategy is working.
That seems to be the implication. They emphasized enhancing product and service quality, operational excellence, and strengthening partnerships, especially with enterprises.
So quality over quantity, maybe, and focusing on business clients.
That seems to be a big part of it. What really stood out was their focus on what they called process engineering in specific niche categories. It's about fine-tuning everything.
Can you give an example?
Sure. Take flowers and cakes. Super time-sensitive, presentation matters hugely. For those, during peak holiday times, they actually deployed support teams on site with the merchants to help sort and distribute orders efficiently.
Wow, that's hands-on.
Very. It's not just about speed, it's about ensuring the cake arrives looking perfect for the birthday party. It builds trust in a high-value segment.
And what about other tricky items, like electronics?
Yeah, 3C electronics, computers, phones, that sort of thing. High value, easily damaged. They've made specific improvements there too. Better packaging, more robust protection, plus specific rider training on how to handle fragile, expensive goods.
Again, focusing on where they can add unique value.
Exactly. It's not about being the cheapest for every single delivery. It's about being the best, the most reliable for these high-value, often time-critical deliveries where their dedicated courier model, one rider, one order direct delivery really shines.
That makes sense. They're carving out a niche based on quality and reliability, not just speed or price.
It seems that way. It's disciplined. Maximize the value per delivery. Don't just chase volume.
Okay, that focus on niche quality makes sense. But a delivery service is only as good as its riders, right? Especially with their dedicated model. In such a competitive market for gig workers, how are they managing their rider force?
That's absolutely crucial, and they did talk about it. They stressed having a comprehensive support system for their riders.
Like what specifically?
Things like subsidies based on clear standards, regular professional training, not just how-to, but safety too, and reward programs, like recognizing top-performing riders each month.
Trying to build loyalty and motivation.
Precisely. They know a happy, well-supported rider is more likely to provide that high-level service they're aiming for.
And does technology play a role here too? They mentioned their dispatch system.
Yes, they highlighted optimizing their intelligent dispatch system and delivery rules. The goal is twofold. Allocate orders efficiently, of course, but also ensure riders get stable earnings.
Stable income is key for retention in the gig economy.
Absolutely. Predictability matters. And management made a point of saying that even with industry-wide pressure on finding and keeping riders, their own numbers, both registered riders and new signups, remain strong.
So their model seems resilient on the labor side too.
It suggests they have created a relatively attractive proposition for riders, which is quite an achievement in this market. It underpins that whole quality service strategy.
So bringing this all together, it really comes back to that initial puzzle, doesn't it? Why the positive market reaction to falling revenue?
And I think the answer lies in this strategic narrative. It looks like investors bought into the focus on profitability, the margin expansion, and the shareholder returns via the buyback. They prioritize that over just raw top-line growth.
A shift in perspective. Maybe profitable niche leader sounds better than shrinking mass market player.
Potentially, yeah. It's a narrative shift. The company is consciously choosing its battles, focusing where it can win profitably.
So looking forward then, what's the plan for the second half of 2025? Are they doubling down on this strategy?
Seems like it. They said they'll continue embedding these refined management principles, aiming for optimal resource use, maximum efficiency, tight cost control. All sounds consistent.
Any new initiatives?
They mentioned exploring innovative brand promotion strategies, trying to connect more with users' daily lives, and deepening those collaborations with high-value merchants, even offering tailored logistics solutions. It's about embedding themselves further into those profitable niches.
Solidifying their position.
Right. And interestingly, management, including the CFO, expressed optimism for the second half. They expect overall order volume might actually recover a bit as some of the intense competition perhaps eases off.
Oh, interesting. So maybe volume won't be declining forever.
That's the hope. They also plan to expand their business development and delivery teams slightly to strengthen capacity.
Yeah.
So it's not like they've given up on growth entirely, but it feels like very disciplined, targeted growth now.
What should we watch for them? Potential catalysts.
I'd say keep an eye on progress with those enterprise partnerships. Definitely watch the execution of the buyback. Are they continuing to buy shares? And obviously, the Q3 earnings will be the next big checkpoint.
Right. Can they keep those margins up? And does order volume stabilize or even tick up if they manage that?
Then that profitable niche leader story gets a lot more convincing, and you can see more investor confidence build.
So for you, the listener, trying to make sense of these market moves, what's the takeaway? It feels like a really compelling case study. A company facing immense pressure, making very deliberate choices.
Yeah, choosing to carve out a profitable space by leaning into what makes them different, that dedicated service model, rather than just trying to outvolume everyone else. It's adaptation in action.
Quality and efficiency over just scale, which naturally gets us thinking, what could this mean for the stock? And that brings us to our favorite segment.
Yes, the "this is not financial advice" segment.
Absolutely not financial advice, purely an intellectual exercise. Let's brainstorm an outrageous but maybe plausible trade idea for BingX, symbol FLX, based on everything we've just discussed.
Okay, let's have some fun with it, considering the stock is still way, way down from its IPO levels.
Yeah, I saw something like 80% down, even after that little pop post earnings.
Right, and management is actively buying back shares right now around $3.10.
So here's a thought, purely hypothetical. Go long FlashX, ticker FLX. The idea would be to target maybe the $5-6 range over the next, say, 12 to 18 months. That time frame roughly lines up with the duration of their current buyback program authorization.
Okay, so what's the core thesis there?
It's basically a buyback-fueled value play meets niche turnaround story. You're betting that the market starts to recognize and reward the shift towards profitability.
And the outrageous part is betting on a substantial re-rating. You're hoping that the consistent buybacks create a solid floor under the price, while the sustained gross margin improvements, combined with any sign that order volumes are stabilizing or recovering as competition maybe cools off a bit in the second half, that all this eventually forces the market to see the company differently.
Not as a shrinking company, but as that profitable niche player.
Exactly. Propelling the stock much higher from these depressed levels, even if they never get back to those crazy IPO-era growth rates. It's a bet that disciplined profitability and shareholder returns finally win out over the obsession with top-line growth that punished them before.
A bet on a narrative shift finally taking hold? Interesting. Yeah. Again, purely hypothetical.
Absolutely. For educational purposes only.
So that wraps up our deep dive into BingXLTD. What really stands out at the end of the day, for me, it's that clear choice. Profitability and specialized service over just chasing volume in a brutal market. And for now, the market seems to be nodding along.
Yeah, it's a fascinating strategic pivot. It really makes you think, doesn't it? In markets where growth at all costs seems like the mantra, could FlashX be showing a different, maybe more sustainable way forward for certain types of digital service companies? Something to mull over?
Definitely food for thought.
And just the standard reminder. Everything we discussed here is for informational and educational purposes. It's definitely not financial advice. Always do your own research before making any investment decisions.
We hope this discussion gave you a much clearer view of FlashX's strategy, their performance, and what might be next. Keep an eye on those gross margins. Watch that buyback activity. Those are the signals to track. Thanks for joining us on the Deep Dive.
We catch you on the next one.